Hey guys, this is Randy with Right Side of the Chart. It is Monday about 11:40. Oh, it is 11:48 Eastern Time as I'm starting this video, and I just wanted to do a quick overview um, for the market update that I put on the front page this morning right after the markets open. I mentioned taking a day trade short position, which could depends on how things play out. I may take some of that home as a swing trade. And what I mean by that, using those terminologies, when you day trade, by definition, that means opening a trade and closing it the same day, whether you short and cover it by the end of the day or you go long and you sell out your position by the end of the day. Day trades don't involve overnight risk. And typically, because you're only trading within one trading day, the moves are much smaller in percentage terms than a swing trade. As such, because you don't have overnight risk and because you're targeting a much smaller gains and losses, you use the same risk to reward ratios or principles that you'd use on swing trading. But because of that, you can take a much larger position because you don't run the risk of an overnight being caught on the wrong side of an overnight gap, which can bypass your stop loss orders if you're swing trading. And and for those reasons. So now by allowing the potential to morph into a swing trade, in other words, by the close, win or lose, target hits, profit targets hit, or stops hit, I'd be closing that trade out because, again, you don't want to take home that overnight risk, especially in this market. This market is not directional by any means, but if I saw something by the something, let's say, a big impulsive move down, a break below support, high volume selling, anything that might convince me to take a little bit of that position home, I certainly will consider that, but I won't make that decision until this afternoon. So just to go over this trade real quickly, posted, I could have shorted the Qs, the SPY, but I chose the IWM today. Typically, you have a little more juice, if you will. The small caps are higher beta index when compared to the broad markets, such as the S&P 500. Meaning, and I'm speaking in generalities here, there are day-to-day differences, but for the most part, when the market goes up, you're going to see the small caps rise more in percentage terms than you will the large caps. For example, here's the small caps up 1.35% as I type, and we look at the SPY, and it's up 0.68. And again, that's generally speaking, you'll see that. So therefore, if you're going to day trade, and I made the case, as I'll show you here real quick, and we had the SPY at resistance. We have this triangle pattern. These are 60-minute charts I'm on, by the way. So we have a nice downtrend line here where so far it's tried to get above. I often talk about when I'm trading the 60-minute time frames that I'll allow for a 60-minute close. And the reason is, somebody mentioned in the trading room, or I'm sorry, on the front page in reply to that post this morning, that the light volume could lead to some stops being run by the big boys, the institutions. They can certainly, especially when the volume is very light in the market, they have enough capital at times to go in, gun the market, hit some buy orders to run stops, and it's not uncommon. You can see here with these 60-minute candlesticks to get these little pops above, pops below. We're still struggling with that line, and I also mentioned this is a level I've been watching for months now. Really, I call it the midpoint of this trading range. It may not be exactly in the middle, but it's a level defined by a lot of reactions where, I've talked about this before. The markets for the last 2 months either traded above or below that level. You've had this range. Once it got above, a few whips down below, but for the most part, you can see how the trading was clustered there. Before that, it was below that level. Since it broke down, it's been below that level, failing on the 217. And again, there's always those brief, runs where these are stop clearing runs. They run you up above. For example, this was the bottom of a gap. The S&P tried to enter the gap and failed. So I like to use 60-minute closes when trading the 60-minute charts, not just any pop above support or resistance level. And I also like to give it a little room, a little buffer. And that's why I mentioned there, if somebody would have wanted to short the SPY, I mentioned an objective stop. Let me reference that post. What did I say there? 217. Okay, there it is. I had to pull up a post or the chart. I mentioned a 60-minute close above 217.25, which would put you up, a little bit above that 217.07 level that's really contained a lot of the reaction. So, all right, let's just break down the IWM trade. Again, I took IWM just to, for the possibility of a little higher gains than I might have shorting the same amount in the Qs or the S&P 500. And so far, I mean, the trade is really about where I posted the entry earlier. Let's see, that was at right up here at this line. That line's at 124.72. I think it was 124.68 or so, about where I posted that as a short and about where I shorted that today. So, on a tag of resistance, you can see how well defined all these reactions that you can see from once we reach that level before, and more importantly, you have a big gap. I love gaps. Gaps often act as very good support and resistance. And this is actually an island top, if you will. You can see an island cluster. You see this cluster of candlesticks with a gap. We gapped up to that level and then gapped down below it. And so far, that's where we're back testing. So this is a pretty decent resistance level. There was even a gap back here a little bit above that level. So a pretty decent level. And again, trading's all about putting the odds in your favor, taking favorable risk reward trades, and going back to that point about a potential stop rate. That's why shorting here at around 124.70 and using both a 60-minute close above resistance and given a little bit of a buffer. If they want to run the stops, they want to take it up a little bit. This is where my stop is set on a 60-minute close above 125.22, which is just that's the buffer I'm giving. Yeah, I would never, if you want to place a stop right above a well-watched resistance level, especially not using a 60-minute close, you're all but guaranteeing that there's a lot of inexperienced traders probably putting their stops there as well because they see that level. It's so visible, and all they have to do, the big boys just have to gun it up, pop those stops. Once the stops are hit, you get a little extra run. So in other words, if they can pop it right there, all those buy to cover orders for anybody that shorted, and maybe longs want to jump in long, they think that's a breakout of resistance, so there's a little surge of buying, you get a brief pop, and then you fade. That pop will fade. At least that's the plan. That's what I hope will happen. Trading, nothing's 100%. So there it is. A short at resistance, well defined, and more importantly, again, not just IWM. I could care less if IWM's at resistance if the QQQ and SPY and the mid caps, Wilshire 5000, if they're all breaking out, if the large caps and the mid caps are breaking above key resistance levels and breaking out, then it's only a matter of time before IWM follows. So I would never trade any one index without keeping the others, a close watch on the others. So this lined up because you had all the indexes at resistance, and we've been in this trading range. You can see it's back and forth, back and forth. So swing traders aren't making money. It's impossible if you're a swing trader. This is just a sideways grind. At best, if you haven't been stopped out, you're frustrated. That's why we haven't had any official trade ideas on the broad market now in quite a while. However, as you can see, day traders, once you recognize these levels, can short. Once you realize there's a gap here, you could have shorted there. That was a previous reaction. That would have been a logical place to cover. Long, short, long, short. That's been the trend so far. We only made it halfway up before, fell back down. So what I have here are different levels, these yellow lines. I mentioned this is the bottom of the range, really, that we're looking at most recently, with some exceptions. As I said, it's been a very whippy market, but you can see now for the past month or so, this has been the sideways trading range with this brief little breakdown below. These are levels either way. There's a gap right here. You can see the large gap. Then that would be today's Friday's close right here, and that would be your minimum downside target, which wouldn't be a bad trade for a day trade size position, I should say, since day trade size positions are larger than swing trade positions. Since you don't have the overnight risk, you're talking a move of about 0.85, 85, 90, almost 90 basis points. I think we got in right around there, a little bit lower. Try to grab that. There we go. That's about at the entry point. So a 90 basis point, almost 1% trade, not bad on a day trade because again, day trades don't run overnight risk. You're targeting much smaller profit and loss targets or potential. Therefore, you can take a considerably larger position size than you would on a swing trade. And as I said, if depending on what I see, if I see some very bearish, impulsive selling, a break of support, I may take some of that home. And this would be my minimum day trade target here because that's a support level. But I don't believe I'd be covering there. Depends if and when we get there, what time. I'll probably at that point put a tight trailing stop. I'd expect a little reaction there, bounce. But ideally, I'm looking for a move down to the bottom of this trading range. And if that gets taken out, that would be bearish technical event number one. And of course, if these recent lows get taken out, and you can see that goes all the way back here, this isn't coincidental. The market is trading, even though it's in this sideways, frustrating grind, at least frustrating to investors and swing traders. Day traders can watch these levels. They're well defined. You see the bottom of this trading range there. Not coincidentally, is the bottom of the recent these three 60-minute candlesticks here. So this yellow line is a pretty important support level. If taken out with conviction, that means a solid break below, ideally on above average volume, a 60-minute candle close below that level. That should be bearish for IWM. And you can see again that level goes all the way back here. There's other reactions, quite a few reactions from above and below, including gaps. So this, and I'll give you that number right now. That number is, we'll call it 122.25. People love round numbers. So there it is. That is a pretty important level. But again, don't trade IWM in a vacuum. What you want to watch for are the big boys, the SPY, the QQQ. You want to see the SPY, the first bearish technical event would be a break below this triangle pattern. You have this yellow symmetrical triangle. Then you have support here. I should probably use the lower of the two numbers. Let's get rid of that. Put up the value there around 212.36, and that defines the recent lows on the SPY, and of course the Qs, the big leading index. We had that breakdown, that brief break. I still think this 116 level is pretty important. We got below it before. We had that fake down move, I call it. But you really want to see about 114.12, call it 114 taken out. I know that spike there goes a little bit below, but you have support there. So that would be, if all those levels I just mentioned on IWM, SPY, and this, we'll call it 114 on the Qs go, that would be quite bearish, and I believe open the door for the first directional trend. When I say direction, I'm not talking sideways. I'm talking a downside trend. And, there's still work to be done on the upside. The Qs are punching through, making this marginal new high. I'm sure that's being celebrated by, those in the bullish camp right now. And it very well may, have some traction. But right now, this new marginal new high in the Qs is a divergent high, as I pointed out this morning. And from my experience, more often than not, divergent highs fail. Breakouts that are followed or have negative divergence when they occur, as such as we have here. You really look at the yellow down sloping lines. That's more likely to fail. You can also see the QQQ is wedging up. So those are things to watch. And I'd also watch for a break back down below this breakout right now, where I'm talking today's breakout to what I call a marginal new high, very slight new high, no follow through whatsoever. The market's just limped, pretty much hit those levels I pointed this morning and have traded sideways to slightly lower all day. So this is not a breakout with conviction. This is not a new highs breakout that you want to chase. It's not confirmed on volume. It's not confirmed with impulsive buying. And most importantly, it is not confirmed with the rest of the stock market. The S&P 500 still well below those highs, and the IWM. So that's it. I just wanted to share, going back to IWM, what I'm looking at and how I plan to trade that. And again, depending on what I see with the other indices, I may take some profits there, partial profits, or I may let it ride, or I could even book full profits there. And, sooner or later we'll get a resolution in this trading range. I'm surprised, as I'm sure many are. We just don't see this historically, such a tight sideways trading range in the market. And as I keep saying, from such tight sideways ranges, these are like coiled springs, you tend to have very large, powerful moves. So just be ready, have your ducks in a row, whether you're bullish or bearish, have your setups lined up. You know, if you're a swing trader and you want to start positioning for the way you expect this to break, I've been doing that. And that's no secret. I've been reeling in some longs lately and adding some short exposure, and I'm ready to, add a lot more short exposure should this market show us, give us a convincing break to the downside. Likewise, if the bullish case starts to develop and firm up, then I would have to reel in that short exposure and either go flat or start going long if I see some attractive long setups. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed the video.